Hello, everyone. Today, I'm joined by Christophe Defer and Mike DiRuzio from HSBC Climate Growth Partners. How are you doing both today?
Good. It's good to be here, Julian.
Yeah, good. How are you?
Doing great. Where are you guys dialing in from?
I'm in London.
And I'm at home in Jersey City.
Awesome. Well, we always love to have a global podcast, so thank you again both for joining. Maybe starting with you, Christophe, could you define in simple terms, what is HSBC Climate Growth Partners? What sort of investments do you make? What sort of sector and stage?
Sure. HSBC Climate Growth Partners is part of HSBC Asset Management, which is part of the bigger HSBC group, which a lot of people will know predominantly as a bank. As part of the asset management business, we essentially raise and manage funds. In our case, we are a venture and growth equity fund specialized in investing in fast-growing companies and technologies that help solve the climate crisis. We tend to take minority stakes in private companies, pretty early stage. So we're talking million, 2 million of revenue upwards that are growing really, really fast. We have essentially three verticals within climate in which we invest. The first one is what I would call energy and mobility transition. We can talk about this later, but we joined the two together because inherently energy and mobility are more and more the same or linked. The second one is what we call sustainable supply chain. And that's really the broader climate space. And then the last one is what we call climate adaptation. And that's unlike the mitigation, the first two mitigation, there's a whole theme around adaptation.
Maybe starting with you, Mike, we have this overview of HSBC Climate Growth Partners. How did you sort of end up there? And then we'll move over to Christophe and sort of hearing your career story. What drew you to VC? What drew you to HSBC in particular?
I have maybe an unorthodox path into it, although I do hear that often from other VC managers, so maybe it's more common than I think. I actually started my VC career technically as a corporate VC. I spent the first 10 and a half years of my career when I got my start after college at a company called Centrica, which is a large UK-based global energy supplier, although I spent my entire career there in North America. So I kind of had a power and utilities and power markets background, professionally speaking. But along the way, around 2017, got roped in with Christophe into helping to build a new corporate venture capital team for that company. Centrica at the time was very focused on energy tech as being a strategic investor. And that was right around the time when the new crop of climate tech managers and specialists were starting to come onto the scene, and people had switched from using the term clean tech to climate tech. So this new thematic in venture capital was emerging right around the time we were starting the CVC. So that was really the starting place for me to both learn the craft as well as the broader world, specifically of climate tech companies that are emerging. So I did that with Christophe and our team for several years while at Centrica. And then early 2021, we transitioned over to HSBC Asset Management. There's a broader story there that I'm sure Christophe can share as well. But from my point of view, it was really important at that time when we were transitioning over. We wanted to build an institutional strategy. For me, it was important because I wanted to switch from corporate VC to more traditional financial focused investing within that space. And it was an exciting opportunity because we felt in HSBC Asset Management, we had a home and somewhat of a platform where we could build this new capability, fundraise, and kind of build a new series of funds in this thematic. It really allowed me to kind of broaden my aperture from, which was at the time just doing energy, kind of strategic investing, into the broader world of climate, which has been just really totally fun.
And Christophe, it sounds like you and Mike sort of intertwined careers before coming to HSBC, but maybe sort of what were you doing before being at Centrica and what also drew you to HSBC yourself?
Sure. So actually, I'll go way back because I know part of your listeners are students at Wharton, and I'm a Wharton grad myself. Actually, when I was an undergrad, I ended up doing an internship in a venture capital fund on the West Coast. At the time, it was one of these venture capital funds that invested in everything from winery to tech and really got excited about it. And I said to folks, how do I join this industry? And they said, you're either an engineer and you understand the product, or you're a financier and you understand the number. So I was like, okay, I'm a liberal arts degree major. I'll just go do the finance thing. So I ended up going from my liberal arts college, I went to Colorado College as an undergrad, to actually the London School of Economics, where I did finance and accounting. And that led me to a more traditional start to a career, which was in investment banking. Being in London, it was kind of a natural move. And then one thing leads to the next, from investment banking to private equity, large buyout private equity fund called Towerbrook Capital Partners. And it's actually when I was at Towerbrook that I ended up looking at a really interesting deal, which was the potential acquisition of Drax, This was 20 years ago, but Drax at the time was the largest coal-fired power plant in the UK. It produced about 7% of the UK's electricity. What I spent my time as an associate was I was looking at the biomass value chain, because obviously they were already looking to switch from coal to biomass. So in 2005, I was like, this is interesting. I got really interested in the kind of sustainability space from a energy generator's perspective. And it's at the same time that solar, wind, and all these things were starting to kind of pick up. So I decided I wanted to go full energy. So I left Towerbrook. I went to Wharton, and that's when I spent my time really exploring kind of the different aspects of the energy transition, which was just starting at the time. And when I came out of Wharton, I wanted to do energy. And that's when I joined Centrica. And the idea was I'd be inside a corporate that was playing along the entire value chain of energy because it was an integrated player. At the time, the way they used to say it, it was everything from the wellhead to the burner tip. So it was from upstream kind of generation, trading, all the way down to their core, I guess, which is British Gas, a retailer in the UK. And so I ended up spending 10 years there, first 3 years in the UK, last 7 years in the US, variety of roles. I started in M&A, which was my background, but then I ended up doing some commodity structuring and a variety of things. And in the last 4 years, when there was a transition as CEO, I was asked to put together the corporate venture arm of Centrica, essentially the CVC of Centrica. And that's when Mike and I had worked actually on an acquisition together. He was in the business, I was in the M&A team before that. So when we launched the corporate VC, Mike and I were the first two to do that. I then moved to San Francisco. And then I was in San Francisco, he was in New York, and then we built out a team in London and Tel Aviv.
Amazing. It's really interesting to hear in sort of like the wide range of backgrounds, which is, I think, common in VC. So it's cool to hear from you both.
There are many ways to kind of get into it.
Yeah, for sure. So in the next question, I kind of want to start diving into the types of investments that you make. And first question I want to ask about is sort of the role of software in fighting the climate battle, because both of you have sort of mentioned this like energy background, which when I think of, coal-fired power plants, big pipelines, very heavy hardware and infrastructure type projects. And I think that's what a lot of people think about when they think about the climate transition. So the first question I have, and it's for either of you, is sort of to answer, what is the role of software in sort of the fight against climate change, given that that's one of the core areas that you guys invest in?
Mike, you want to go?
Yeah, let me have a go. It's a good question, Julian, because I think people, when they imagine building a valuable business that's trying to address some aspect of climate change, you have to make contact with reality, with atoms to help fix that problem. And so what's the point of software? For us, but also just speaking for myself, it's really important that people understand the first order of solving this problem, particularly the emissions of CO2 in the atmosphere, is about reducing waste in industry. In different economic activities, there's a lot of waste processes and things like that. So digitization, which has been going on now through IoT and edge computing and edge internet for the better part of 10, 15 years, just builds a profile in various industries where you have this rich source of data you can then use through different software products to improve optimization and efficiency, sometimes like transformationally in many industries. Just to make it a little more concrete, for example, we've looked at a variety of different businesses in the methane monitoring space. So in oil and gas wellheads, there's often a lot of flaring going on that goes undetected, or there's leaks that go undetected. You can put interesting solutions near the wellhead within the perimeters of those sites, oil and gas sites, to improve operational efficiency that has a direct impact on reducing methane and CO2 emissions, just as one example. It's not an area we've invested in yet, but just broadly digitizing industry, I think, will improve efficiency and therefore reduce waste and energy and CO2 and so forth. But more interestingly, what we do when we focus on this category is really about machine learning and AI. I think that's where the application of software or software-related type things, so AI and ML, can have a really big role to play in the energy transition and addressing climate change. We've got a number of companies in our portfolio. We actually kind of backed into just being an AI ML for climate fund, because I think a little over half our portfolio companies are basically just AI companies at heart. Our first investment, for example, is a company called Amperon, and they do a number of different things using really advanced ML algorithms for really any electric market participants, so utilities, energy traders, big commercial industrial buyers of energy. And what they do principally is demand forecasting, but also renewable generation forecasting. And that has the effect for the people that need to buy and sell power every day to keep the system balanced, really help them plan optimize their procurement, and manage their renewables. That's an example of AI having a direct impact on the real world grid in this example. I think it's two things. It's broadly the trend of digitization is improving efficiency and resource management in big industries and small industries alike. And then also, as all this data and analytics have built up over the last decade, what we can now do with machine learning and AI to really generate transformational outcomes for climate in different industries, that's really interesting to me.
But if I was to say I'm a climate skeptic, I hear AI and ML, I think power hungry, just to run a lot of those processes and the software itself, huge electricity consumption. So this kind of brings me to a question around sort of like impact diligence and maybe understanding the impact of your portfolio companies. So in a case like Amperon, how do you sort of actually determine whether it's a net positive on the overall electricity consumption and sort of makeup of electricity, given that maybe the project itself is quite intensive? And this can be applied to a broader set of companies. So like, how do you actually sort of go about doing the validation?
I think it's worth distinguishing here because in the last really year or 2 years since Sam Altman and OpenAI have kind of come into pop culture, there's people use the term AI very generically. So yeah, large language models and some neural net models and inference around those systems can be quite power hungry. That's new net demand. Generally, we haven't invested in those types of companies. I haven't quite figured out an LLM model for climate that makes any sense. In our more germane world of general machine learning algorithms, which I lump into A, those tend not to be as power hungry, Julian. Your broader question is a good one, which is how do we assess impact, whether it's in hard tech or software tech? And I think we actually have used a framework where we try to link all of our investments to one or more positive UN Sustainable Development Goal outcomes. For us, the way we integrate ESG is, we're measuring CO2 footprint, so scope 1 through 3. We're measuring energy use. We're measuring water and hazardous materials use where it applies in all our various companies annually. But that's a little bit, to be honest, table stakes. We think a step ahead into, okay, who are the stakeholders or communities that this product or technology or company are actually affecting? And is there some measurable positive change that we can believe in across a spectrum of different outcomes? And those outcomes we use are the UN SDGs. We actually, for our fund, we brought in a third party, effectively impact auditor or impact ratings agency to do this for us. So we're not marking our own homework. That's really important to us. So that's how we think about compliance and driving impact, is through that lens. It's less specifically on, did this company's product this year have XYZ CO2 reduction? Because I do think, at least with software and AI, you are an order, it's sort of a derivative away from that. But that's okay. You can still demonstrate positive change in the world through these other means. So that's what we've done to kind of keep a broader scope on impact.
And Julian, if I can just add, I think generally people are all aligned on what we need to achieve. Like if I take a step back for a minute, I'm not sure everybody agrees on how. And I think that's where there's a lot of room for investment theses in this space. The way we look at it is like, if you all agree that we have to make our planet more sustainable, the question is, how long is it going to take us and how? And I think our thesis relies around the idea that machine learning and AI can help us do what we already do, just better and faster. One might argue, well, that's not going to have as big of an impact as the moonshot technologies like nuclear fusion, DAC, and all these kind of things. There's some truth to that. But at the same time, how long is it going to take for DAC or nuclear fusion to be commercially viable and therefore ubiquitous? We don't want to fall into that Concorde syndrome. Amazing technology, the Concorde plane, never commercially viable. I think we need to give people time to figure that out, and that's okay. But in the meantime, there's a lot of infrastructure out there that can use software to just be more sustainable and more effective. That's kind of the lens through which we look at it.
Let me actually just pile on with one more example, Julian. I was speaking to a company recently, I won't name them. They're a US-based deep tech company that are focused on building new dyes and textiles for the apparel industry. And the way they do that is they're synthesizing proteins that can then create the sort of molecular structures for these products chemically and fiber-wise. And they've leveraged DeepMind and other models in protein folding to help them discover the right protein pathways to build the building blocks of their product. So that's an interesting example. Again, not a company we've invested in, so I won't name them, but an interesting example of a company leveraging broader AI developments and technology to actually generate some cool product that could have good in the world. We should also stress, by the way, we're not a software-only fund. We have done some harder tech things, which we would love to talk about. But there's so much we can do through AI and machine learning to just improve outcomes in industries that I think is really important to focus on today.
Yeah. Well, I think you led me to a perfect transition. My next question was going to be around sort of investing in hardware instead of those more physical, quote unquote, businesses. For at least my generation, which has kind of grown up in the software VC epoch of 2008 to 2020, it often feels weird that VCs are investing in hardware, but this tends to be, I think, a little more common, especially in the climate space. But I wanted to ask you both. Conventional thought is that hardware startups are harder to scale, harder to maybe get a return from quickly. And as a result, are maybe slightly harder to get LPs to buy into, given that they may be expecting these software sort of returns. A, is it the case that hardware startups are a little bit more challenging from a business perspective? Or is that not actually sort of really the case based on your sort of initial experience? And maybe, Christoph, you can take that.
Yeah, I guess I'm going to give you the typical answer, like it depends. It depends what type of hardware you're talking about. I think one lens I would put on it is maybe familiar with the TRL scale. So when you talk about hardware, it kind of depends where you are in terms of technology readiness level. If you're very early stage on that scale and the technology you're developing is a very capital intensive technology, then yeah, the likelihood is it's going to take you a lot more capital and more importantly, a lot more patient capital. And in climate, you're seeing a lot of that coming through, and actually funds are adapting to that. So you're starting to see funds that are 15-year funds instead of the traditional 10-year fund. So it's going more towards infrastructure fund type models. So I think the financing models are evolving to serve that market. On the other end, you have some hardware businesses or hardware dependent businesses that are maybe using or either are able to be up the TRL scale higher or are using more standard hardware but assembling it in their own proprietary ways and then adds a layer of software on it. And that may be much more commercial, faster, but maybe the perceived impact maybe less. It depends. For us, because we have a more traditional VC model, we'll tend to go to the latter because it fits more our investment profile, but it doesn't mean they're not investors along that entire spectrum of hardware. But I think generally that's a long-winded way of saying you're right in the sense that hardware tends to be more difficult, if anything, because as an investor, you have to start taking into account the concept of working capital, which you wouldn't do for like a software business. It's just a different model.
Could you maybe give us an example of what is sort of the typical style of hardware startup that you guys as a fund investment? I think a lot of people have the conception of a large geothermal facility to generate power or hydrogen, but that are the typical capital intensive, first of a kind technologies. Maybe what are sort of the more akin ones that you guys invest in?
Well, the one I think you're probably going to be most familiar with, Julian, because their founder and CEO is on the show, is Electric Era, which incidentally is currently our fastest growing company year over year in terms of revenue. So to go back to your first question about how hard is it to scale, it is difficult, but it's not always the case. In that example, for your audience, in case they're not aware, Electric Era, it's a fantastic business. They're an EV fast charging company out of Seattle, Washington. They build really an all-in-one level 3 solution that's battery buffered for C-stores and retailers that want to really be their own owner-operators of public fast charging networks. There's a lot of really high-quality advanced engineering that's going into that business. By the way, both software and hardware. But ultimately, they're not bending metal. They're not fabricating their own battery cells, for example. So there's a lot of components across a global supply chain they can source to put their charging dispensers and batteries and power electronics and so forth together into a complete solution. So that's an example where, to Christoph's point, on the technology readiness scale, it's obviously 9, right? The most mature scale. It's market ready, it's testable. They're building it, they're deploying it. Customers are using it and being delighted by those stations today. As a fund, many peers of ours do sort of deeper tech things like advanced geothermal. We certainly look at and keep research and market scans on all of those types of companies, fusion and so forth. But where those technologies exist on a lower TRL scale, it is our view that sometimes venture capital is not the best use of capital at the earlier stages when you're still in R&D with your engineering. If you're working out the science or you're working out how to convert the science of something into basic engineering, VC is very expensive. That's a tough putt to make as an investor and maybe also as a founder. There are companies doing it, and honestly, I wish them well because we need some of those more experimental technologies eventually to mature, but it's just a longer cycle of development. So when we think about infrastructure or hard tech, it's the electric eras of the world that we get super excited about. It's also not just infrastructure, it's biomanufacturing. That's another area we've made a couple of investments in that some might consider deep tech or hard tech. So you're making a physical product. In this case, you're replacing petrochemicals with some bio-based material through fermentation or what have you. Those can be challenging businesses too, but they can be very exciting. So we'll look at those where their product is beyond the lab stage. We think there could be really interesting applications for biology and chemistry, and that's something we've been investing in.
I'll just add what we're describing here is our choice of investing thesis. I think we tend to use venture kind of ubiquitously through the conversation, and venture capital can support hard tech, but the model they're using is probably longer tenured fund, maybe a different returns expectation, or maybe it's more cash on cash rather than IR. It kind of depends. One of the trickiest thing in the climate space in particular is climate touches on so many different asset classes and types of technology that you just have to find the right capital to match it. Whereas the traditional VC space is like enterprise SaaS, it's much more ubiquitous in terms of matching the technology with the capital. Now, for our own strategy, you brought up hydrogen and direct air capture, and all these things tend to grab the headlines in climate. I saw an electrolyzer technology come through my desk not long ago, and it's not yet gross profit positive. And therefore, for our specific thesis, I'm like, that's the kind of risk that's harder. Like, we're good at helping entrepreneurs kind of grow. We like to underwrite the team, the market, and the scalability of the technology, and not so much the kind of ongoing development. But that's just us.
I think you brought up an interesting element here that it's a big part about VC investing is the team, the founders, and sort of ultimately who's building this company. And I'd be curious to hear from you both of how you actually started developing your bar of what a good founder or what a good team actually looks like. And I'm sure for Christoph, it looks different when you're in the private equity investing space to the venture space. Mike, same thing for you, going from like being in the business to now being in the investing space. How did you sort of start building that muscle, understanding what a good founder is? I think a lot of our audience is probably trying to make that transition potentially into VC and maybe have a similar question. So maybe start with you, Mike.
Yeah, and you mean here, Julian, the entrepreneurs, the operators.
Exactly. Yeah.
Because there's also a venture team, and maybe we could talk about that too. But yeah, absolutely. I've definitely been trying to fine tune my compass on this over the years. I'll admit I've made some mistakes in previous times investing in certain teams. I've sharpened that compass, and I kind of look for 3 or 4 keys, I think, Julian, every time in terms of character pattern to assess whether this is really the right founder to back. And I don't think they'll be terribly surprising to your audience. But firstly, I really stress that I think it's important to invest in generally technical founders. Not necessarily meaning like they have to be PhDs or scientists. What I mean is they have a deep technical domain expertise of what they're doing or building. Like it has to be one of the, either they really understand the technology preferably, or at a minimum, they deeply understand their marketing customer. And then maybe they're bringing in technology that isn't so complicated. A shorthand for this kind of first key is like, generally I want to invest in someone where if all the other employees went away, could that founder still build the product on her or himself? I think that's really important. The second thing similar to that is that person has to themselves be able to really find and locate talent and inspire talent, because that's everything. Most of our venture capital dollars are actually going, or euros, are going into hiring. It's going into payroll. And so that's where your ROI is going to come from, broadly speaking, as a VC. So the person you're backing or the people you're backing, you want them to know they can put together and critically inspire a team that's going to come on board and work really hard. Startups are not 9-to-5 jobs. So if you're bringing 9-to-5 people, it's not going to work. That's really critical. And by the way, for many new CEOs, that is not easy. It's much easier to engineer like crazy AI products for many people than it is to engineer an incredible sticky team. That's actually something that we look at a lot and try to help them with, but that's really important. And maybe the third thing, just to summarize, I think it's general like affability. We're working with people 5 to 10 years in these portfolios. Are they coachable? Do they listen? Do they listen without changing their mind constantly? Like, do they understand their own compass and principles, but they can incorporate opinions from VCs and their employees and advisors and so forth in a way that's productive? That's really, really important, I think, for a leader, for an entrepreneur. Those are kind of the 3 things I would look for out of the gate.
Yeah, I'll just add that I'm not a big fan of the cult of a persona. So they tend to be teams. Most of our teams are a few folks. So the way they work together and the complementary skills and leadership traits they bring in is important to assess. So you assess it more as a package. I think Mike is right that it's also about the people that they can bring around them. I'll emphasize that because I don't think there's a successful person out there, although they make you believe that they've done it all on their own, that can do it without an entire team. And that's really important.
Yeah, it's definitely a very sort of interesting aspect, I think, of the VC business because no one founder looks, I think, very similar to the other. So trying to understand what are those common traits is, I think, one of the unique parts about the business.
Yeah, when we invest at Series A, Series B, like Mike said it, these teams have to be receptive to feedback and doing hard things. Like the likelihood is the stage at which we invest will probably be one of the first stages where they hit a road bump and they might have to shrink the team before they grow it. So can a leadership team face shrinking the team they built to have the hard conversation, to make the hard choices? Do they know how to reallocate resources most effectively? The way I used it recently is one of the most important thing about, I think, a management team in a startup is to really, they build their own gearbox. What they do is they're managing a gearbox, and that gearbox has to be as efficiently as possible. So they know exactly when to accelerate and decelerate and allocate resources the right way. I think that's probably one of the most important things in that process.
We covered how founders maybe sell you both on making an investment, but I'm curious now, how does you guys as a fund, as HSBC Climate Growth Partners, sell yourselves to potential founders to get allocation and deals? How do you sort of pitch the fund? What are the benefits of maybe being associated with HSBC? Just kind of curious to understand that process, and maybe starting with you, Christoph.
Yeah, I guess the first thing we do, if you think about the process that we go through, is that we go find these businesses most of the time. So we're the ones who tend to approach these folks and make the intro. So I don't think we tend to participate in any kind of super competitive kind of beauty parade. So we hopefully have time to build a relationship with these folks, particularly if they're not yet fundraising. So I think Mike will tell you, but I believe we met the folks at Ampron like a couple of years before we were ready to invest, and building that relationship over time and actually selecting the companies we find really interesting and helping them out, even if they're not fundraising, builds that relationship so that it positions you hopefully in a good space once they do. And they're one of the first people they call. You're one of the first people they call when they do. And then obviously it's a matter of then a couple of things. Our experience as a team and the expertise we bring. Obviously we have some experience in the energy space, and I think that has a lot of parallels with some of the new industries that are now looking at sustainability. So that's one thing. And then obviously being part of HSBC Asset Management and the wider HSBC group brings an advantage, which is not so much a sourcing advantage, but more once we have portfolio companies, the ability to connect them with essentially any potential customer out there, because 200,000 people at HSBC, like it's a very big group with a lot of reach. Done the right way, you're only a few degrees of separation from someone you want to talk to. So that's the important bit. And then the one that we cultivate very, very closely and is probably our lifeline is just references from other CEOs of the businesses we've worked with. I think that's probably the most important thing. And ideally, it's not just the situations in which everything went well and everybody loves each other, but when it got tough, how did Mike or how did Christoph or how did someone in the team like help you out? Were they honest, genuine, and did it help you through it? These are the kind of references that I think stick over time.
Now, moving into the final section of the podcast, given we are an MBA podcast, I do sort of want to talk about career and advice. So maybe first starting off, what do you recommend for an MBA who maybe doesn't necessarily have the technical background to be a founder perhaps, or at least be an early stage joiner, to go work in the venture capital space? Is it to join a startup or try and go directly into the VC routes, or any recommendations on that front, or do the typical investment banking?
Yeah, maybe I can offer. Christoph's wiser about this debate, but so let me go first and you can maybe pile on. Honestly, Julian, I think you have to build the skills and experiences to do this well. So if you're an MBA interested in venture capital for whatever, if you've already come to that conclusion, you should go and try to buffer your skills and experiences, the ones that you're going to need. And I think one thing that I think is so critical coming into this as an investor, it's just like investing in anything. You really need to understand what separates a fantastic business from a mediocre or not great business deeply. And Beyond a great education at Wharton, for example, I think that starts with working as an operator in a business, preferably. That's particularly one path I would recommend. Go work at a Series C or B stage company, if you can find a role there, in an area that interests you, and understand what a fantastic, particularly, I mean now, technology company, okay? Understand what that looks like, or what a bad one looks like from the inside out. I think that's a great way to round out your radar and your analytical abilities and your intuition about investing in other tech businesses in the future. If you want to go right just into investing, honestly, I wouldn't even start with VC. I would start with something more like growth, like late stage or even private equity. Again, because you're going to learn more about the fundamentals. You want to learn more about the fundamentals of like what makes a great technology business tick and all the things you need so that when you show up to a VC firm, you have a little bit more of a resume where you can operate independently as an associate or as a principal. That's what I would be looking for in a hire. Is someone I can just leave on their own. They come back and bring a ton of value. Where generally early stage VC, when I think about venture capital, I mean early stage, you don't have these large teams. There's a couple of sandhill firms that are quite large, but generally most firms are small, sub 20-person outfits. If you can come in and add value, that means you're operating alone, you're identifying what could be a fantastic technology business looks like and building those relationships. And I think that starts by getting experience somewhere else.
Yeah, I think that's right. If I take a step back for a minute, I think the two most important skills you need are curiosity and critical thinking. And the most important one in all of that being probably critical thinking. And that's what Mike is getting to. However you acquire the critical thinking, it could be the experience in a startup. It could be in an investment, a different type of investment. Like I did that in investment banking, private equity to start with. But it could also be in a corporate. I mean, Mike started his career in a corporate, but I guess he was in a position where it was a strategy position and an operating position where critical thinking was important. So I think that's what you have to bring to the job. And then the experience that you get, whether you work in an energy company or a fintech company or whatever it is, that is value add as well. I think that's what I would aim to do. And then look more practically to actually get a job. I think your story needs to hold together. I think the way you essentially take your experiences and assemble them like a Lego, it'll give you a comprehensive story of where have you been and why do you want to go where you want to go. And that needs to be a story that all fits together.
Sure. Well, I think where we started in the beginning of the podcast is that there's no one way to get into VC. So I like that we kind of made a full circle there. We're coming to time, so thank you both, Christoph and Mike. This was an absolutely great episode. I'm sure the audience is going to love it just as much as I did. So thank you both.
Thank you very much.
Appreciate it, Julian. Good to talk.